Diversification. It's one of the most used words in personal finance. Everybody says it. Don't put all your eggs in one basket. Spread the risk. Diversify your portfolio. But here's the thing. Most people who use that word and most people who nod along when they hear it don't actually have a precise understanding of what diversification means. Or more importantly, how to do it correctly. And getting it wrong has consequences that are just as bad as not diversifying at all. So today we're going to break down what diversification actually means. Not the vague idea. The real thing. What it looks like in practice. Why it matters. And how regular people can get it right without a finance degree. Let's start with the basic idea. Diversification is the strategy of spreading investments across different assets so that the poor performance of any single investment doesn't destroy your entire portfolio. The logic is simple. Different investments don't all move in the same direction at the same time. When some go down, others might hold steady or go up. By owning a variety, you reduce the impact of any single bad outcome. This is risk management, not eliminating risk, reducing it, spreading it, making it so that no single bad event, a company failing, a sector collapsing, an industry getting disrupted takes your entire financial future with it. Let's start with the most basic form: stock diversification. If you own stock in one company, your financial fate is tied to that company. Company does well, you do well. Company struggles, you suffer. Company goes bankrupt, you could lose everything you put in. History is full of people who concentrated their wealth in one company's stock. Enron employees who had retirement savings entirely in Enron stock. Investors who went all in on a single tech stock in 2000. When those companies collapsed, so did those portfolios. Owning stock in one company is not investing. It's betting. Now own 10 companies. Much better. Any one of them can fail without wiping you out. But what if all 10 are technology companies? When the tech sector crashes, all 10 might go down together. That's sector concentration risk. Owning many companies in one sector is better than one company, but it's still not true diversification. True stock diversification means owning companies across many sectors. Technology, healthcare, financials, consumer staples, energy, utilities, industrials, real estate. When tech drops, healthcare might hold. When energy struggles, consumer staples might be stable. Different sectors respond differently to economic conditions. Spread across sectors, the volatility of any one sector has a muted effect on the whole. The easiest way to achieve this: index funds. A total U.S. stock market index fund owns thousands of companies across every sector. Instant diversification. No individual stock picking required. One fund, full market exposure. But stock diversification is just layer 1. Layer 2: geographic diversification. Owning only U.S. stocks means your entire portfolio is tied to the U.S. economy. The U.S. market has been dominant for decades. But other economies exist. They grow. They innovate. And they don't always move in lockstep with the U.S. International diversification, adding exposure to developed markets like Europe and Japan, and emerging markets like India and Brazil, reduces the risk that a U.S.-specific economic event devastates your entire portfolio. A total international stock market index fund handles this automatically. A common approach: roughly 70% to 80% U.S. stocks, 20% to 30% international. This gives U.S. exposure as the foundation while hedging against U.S.-specific risks. Layer 3: asset class diversification. Stocks are one asset class, but there are others: bonds, real estate, commodities. Different asset classes respond differently to economic conditions. When stocks are volatile, bonds often provide stability. When inflation is high, real estate and commodities sometimes outperform stocks. Adding different asset classes, particularly bonds, reduces overall portfolio volatility. For younger investors, a heavy stock allocation makes sense because the time horizon is long. Short-term volatility doesn't matter much when retirement is 30 years away. But as retirement approaches, adding bonds and other stable assets reduces the risk of a bad market year devastating a portfolio right when you need to draw from it. A classic guideline: subtract your age from 110 to get your stock allocation. 30 years old, 80% stocks, 20% bonds. 50 years old, 60% stocks, 40% bonds. 65 years old, 45% stocks, 55% bonds. This isn't a rigid rule. It's a starting framework. Adjust based on your risk tolerance and retirement timeline. Layer 4: time diversification. This one is less talked about but equally important. Dollar cost averaging. Investing a fixed amount consistently over time automatically diversifies your purchase price. Some months you buy when prices are high. Some months you buy when prices are low. Over time you average out to something in between. This reduces the risk of putting a large sum in at exactly the wrong time. The person who invests their entire savings on one day right before a crash is in a worse position than the person who invested that same total gradually over 12 months. Time diversification, consistent contributions over time, is risk management built into the habit of regular investing. Now, common diversification mistakes. Mistake 1: thinking more funds means better diversification. Some people own 15 different mutual funds thinking they're diversified. But if all 15 funds are actively managed US large-cap funds, they all own the same stocks. Owning 15 funds with the same holdings isn't diversification. It's duplication with 15 sets of fees. True diversification is about owning different types of assets that don't move together, not just owning more funds. Mistake 2: being over-diversified to the point of dilution. There's a point where adding more positions stops reducing risk and starts diluting returns. Owning 5,000 individual stocks or 30 different overlapping funds isn't meaningfully more diversified than owning 2 or 3 well-chosen index funds. Simplicity works. A 3-fund portfolio, US total market, international total market, and a bond index fund, is genuinely well diversified for most investors. 3 funds. Total coverage. Minimal complexity. Mistake 3: not rebalancing. Over time different assets grow at different rates. A portfolio that starts as 80% stocks and 20% bonds might shift to 90% stocks and 10% bonds after a strong stock market run. Now the risk profile has changed without any decision being made. Rebalancing, periodically adjusting back to target allocations, keeps the risk level where you intended. Once a year is typically sufficient. It's not exciting. It's not complicated. But it's an important part of maintaining a diversified portfolio. Here's the simple diversification framework for most people. Total US Stock Market Index Fund Core Holding. Total International Stock Market Index Fund Geographic Diversification. Bond Index Fund Stability and Asset Class Diversification. Contribute consistently. Rebalance annually. Leave it alone. That's a properly diversified portfolio. No exotic assets needed. No complex strategies. No constant monitoring. Just 3 funds systematically covering the most important bases. Diversification doesn't eliminate risk. Nothing eliminates risk. But it reduces the specific risk of being wrong about one thing, one company, one sector, one country, one economic cycle, and having that one thing destroy your financial future. And that protection, that resilience, is the foundation of sustainable long-term wealth building. Hit like if this cleared up what diversification actually means. Subscribe for the full series. Don't bet on one thing. On everything. Let the market do the work. See you in the next one.